Welcome to Ito Analytics, the leading platform for providing volatility data and option analytics. This is Chapter 7 of Option Trading Tutorial Series. We will continue to talk about option strategies. We covered buying call and buying put in previous chapter. We will move on to talk about selling options, starts with selling call options. Selling call is a way to express bearish view on underlying asset. This is because option value decrease with underlying spot moving lower. This is the payoff diagram of selling call. It looks like the upside down of buying call. At a quick glance, selling call has no upside payoff, but in fact, option sellers receive option premium at inception to compensate for that. Selling call is about receiving option premium to underwrite upside risks to option buyers. Option is composed of intrinsic value and time value. Sell call means receiving time value and underwriting upside payout to call buyers. Effectively, call sellers receive daily theta as compensation for giving the leverage buying power to call buyers. The advantage of sell call is that call sellers receive daily theta, which is a positive carry trade. The disadvantage is that the potential loss of call seller is uncapped when underlying asset moving up dramatically. The game plan of call sellers is relatively simple. Call sellers just need to sit with the option until the maturity. If the call expires out of the money, the call sellers pocket the entire call premium received at inception. If the call expires in the money, then the profit and loss will be premium received minus payoff of call, which is spot minus strike. For example, assume a trader sold in 1 month, $105 strike call with premium $2. Apple is at $100 now. 1 month later, if Apple goes down to $90, then the call will be expired out of the money, thus worthless. Profit for the call seller will be the full amount of premium, which is $2. But if Apple goes up to $110 after 1 month, call option payoff will be 110 minus 105, which is $5. Thus, the profit and loss for call seller will be $2 of initial premium minus call payoff of $5 equals to negative $3. Next, we would like to talk about one common way to use sell call strategy, the covered call. Covered call means trader originally holding some underlying asset, then selling an out-of-the-money call option. The idea is to forgo some upside return on underlying in order to receive call premium as extra income. This is the payoff diagram of covered call. This is a graph by overlapping payoff of long underlying plus selling a 120 strike call. Below $120, the graph is a straight line with slope 1. This is exactly the same as long the underlying asset. The payoff is flattened when spot goes above 120 because stock will be sold at strike price as a result of the short call expiring in the money. The game plan of covered call is to sit with the short call position until the maturity. If the call expires out of the money, then trader will pocket all the call premium and will be still holding the long position underlying asset. Compared to just holding the underlying asset, covered call gives trader extra call premium. If the call expires in the money, then the long underlying position will be sold at call strike. Trader will have pocketed the call premium plus the profit from selling underlying holding at call strike. As we can see, this strategy is about forgoing potential underlying's return above call strike in order to get the extra call premium. The call strike can be thought of the target level to sell the underlying asset. For example, a trader is holding an Apple and just sold in 1 month $105 strike call with premium $2. Apple is at $100 now. After 1 month, if the Apple goes down to $90, then the short call will be expired worthless. At that point, the trader will pocket $2 of call premium and still holding the Apple. If Apple goes up to $110 after 1 month, then the short call will be expired in the money. The profit will be $2 of call premium plus profit of underlying holding gets sold at call strike, which is 105 minus 100. Total profit will then be $7. And after underlying gets sold at call strike, trader will be left with no more holdings on Apple. For selling call, in the case of both naked call and covered call, the key is to look at the option specification and check the premium as percentage yield before entering into the trade. Annualized premium is calculated as absolute percentage premium divided by tenor in years. Call sellers can use this measure to compare call option with different tenors and strikes, and then select those with reasonable yield to sell. The last thing to keep in mind is that when the percentage premium yield on current short call position become very small, usually due to strike is far from spot, traders can consider buying back the call or rolling the call to longer dated one. The next strategy is selling put option. Selling put is a way to express bullish view on underlying asset because put value decrease when underlying moving higher. This is the payoff diagram of selling put. There is no upside in the payoff. This is because selling put received premium at the beginning. Selling put is about receiving premium at beginning to underwrite downside risks on underlying asset. One special thing about this strategy is that put sellers will buy the underlying at put strike when the short put expiring in the money. This strategy can be thought of positioning to buy the underlying when underlying spot drops to put strike level. Selling put means receiving time value to underwrite the downside payout of put to option buyers. Effectively, put sellers receive daily theta to give put buyers the leverage power for betting on underlying's downside moves. The advantage is that put selling is a positive carry trade as put sellers receive daily theta. The disadvantage is that the potential loss could be huge when underlying crash dramatically. The game plan of put seller is to sit with the short put position until the maturity. If the put expires out of the money, then the put seller will pocket the put premium. If the put expires in the money, then the put seller's profit and loss will be premium received minus the put option payoff, which is strike minus spot price at maturity. If the put option is a physical settling option, then the put seller will buy the underlying at put strike price. Effectively, the put seller receives put premium at beginning of the trade. If underlying drops below put strike level, the put seller will buy the underlying at put strike. For example, assume a trader sold in 1 month $95 strike put on Apple at premium $2. Apple is $100 now. If the Apple goes down to $90 after 1 month, then the put will be expired in the money. Profit and loss will be $2 of premium received minus the put payoff, which is 95 strike minus 90 spot price. Thus, the trader will lose $3. If the option is a physical settling one, then the trader's payoff will be receiving $2 premium at beginning and then buying the Apple at $95. The trader will be holding an Apple after the put expiry. If Apple goes up to $110 after 1 month, then the profit for the trader will be simply the $2 premium received at beginning. Similar to selling call, the key of selling put is to estimate the put premiums as percentage yield, and use this percentage yield to compare put options across different tenors and strikes and select the ones which are reasonable to sell. Strike price is an important element here, because it is the price that traders pay to buy the underlying if the put expiring in the money. The last note is, premium as percentage yield will get smaller when spot price of underlying is far away from strike and put option is very close to maturity. In this case, put seller can choose to buy back the put or roll the put to longer dated one. As summary, we talked about selling call and selling put in this chapter. Selling call is a way to express bearish view and selling put is a way to express bullish view. Both strategies are about underwriting upside and downside risks to option buyers and receive option time value in return. Strike and premium as percentage yield are the key to select options to sell. This is because strike is the effective price to sell and buy the underlying, and premium as percentage is a measure to estimate if it is worthy to sell the options. Viewers can visit Ito Analytics website and get access to Ito Analytics Option Pricer in order to utilize the knowledge in this chapter for option trading. This is the end of Chapter 7. Subscribe and visit Ito Analytics website for more option-related contents.